Be greedy when others are fearful, and fearful when others are greedy. Warren Buffett. Imagine a moment when the market collapses. The headlines are apocalyptic, investors rush to sell their stocks, and fear dominates the economy. For most, this scenario is a disaster. But for Buffett, this is the perfect moment to get rich. Why do some people lose everything in crises, while others take advantage of them to build fortunes? The answer lies in how we perceive and react to these moments. Warren, one of the greatest investors of all time, believes that crises are disguised opportunities. He built much of his wealth by investing precisely when others were panic selling. While the world saw chaos, he saw discounts on solid companies. Today, we will explore how you can apply this mindset to turn moments of crisis into springboards for wealth. We will understand his principles, how to identify good opportunities, and how to act wisely when everyone around you is consumed by fear. If you want to learn how to take advantage of crises to get rich, stay until the end, because this knowledge could change your financial life forever. He learned early on that the financial market is driven by two main emotions: fear and greed. When the market is booming, people become euphoric and buy stocks without assessing whether the prices make sense. But when a crisis occurs, fear takes over and everyone wants to sell, often at prices far below the real value of companies. Buffett takes advantage of this dynamic. Instead of following the crowd, he does the opposite. He buys when everyone is selling and sells when everyone is buying frantically. This behavior goes against human nature, but that is precisely why it works. His first lesson on taking advantage of crises is to focus on solid businesses instead of getting carried away by market fluctuations. During a crisis, excellent companies may see their stocks drastically devalued, not because their business model has worsened, but because investors are in panic. For example, during the crisis of 2008, many stocks plummeted. Bank of America, one of the largest banks in the United States, took a massive hit. Warren saw this as an opportunity and invested billions in the company, securing a spectacular return years later. Here is an essential principle. Stocks are parts of real companies, not just numbers on a screen. If a business remains strong, generating revenue and well-managed, its real value does not change just because the market is in panic. If you want to profit during crises, you need to look at a company's fundamentals, not the market's fear. He always says, price is what you pay, value is what you get. This means that a stock's price may fluctuate with market sentiment, but the real value of a company changes much more slowly. In the crisis of 2020, for example, companies like Apple, Amazon, and Google saw significant drops in their stock prices. However, the business models of these giants remained strong. Those who took advantage of the panic to buy saw massive returns in the following years. If you want to find good opportunities in times of crisis, you need to ask yourself if the company has a lasting competitive advantage, if it is well managed and profitable, and if it has low debt and strong cash generation. If the answers are yes, then it might be a great buying opportunity. Another crucial strategy of Warren's is always keeping cash on hand to take advantage of crises. This may seem simple, but few investors do it in a disciplined way. He compares this strategy to a baseball player waiting for the perfect pitch to hit. He doesn't go around buying stocks all the time. He prefers to wait patiently until a great opportunity arises. During the crisis of 2008, Berkshire Hathaway had tens of billions of dollars in cash. This allowed Buffett to buy companies and stocks at extremely low prices. When the market recovered, the profits were enormous. For the average investor, this means you should always have a financial reserve set aside for investments. That way, when the market drops, you can buy good companies at discount prices. Now that we understand the basic principles of how he sees crises as opportunities, let's dive deeper into the mindset and strategies he uses to make the most of these moments. Warren always emphasizes that investing is not a speed game, but one of endurance. He believes patience is one of the most valuable qualities for those who want to build wealth. In practice, this means that simply buying stocks because prices have dropped is not enough. You must wait for the right opportunities and, most importantly, be willing to hold your investments for years or even decades. A classic example of this is Coca-Cola. He bought shares in the company in 1988 when the market was unstable. More than 30 years later, he still holds the position and receives billions in dividends. This teaches us that the biggest mistake investors make during a crisis is acting on impulse. Those who panic and sell lose money. Those who wait and invest wisely become wealthy. Buffett has a simple method for finding opportunities. He looks for undervalued companies, those being traded at prices far below their real value. But how do you identify these opportunities? Here are some key metrics he analyzes. If profits are consistent, since companies that continue to be profitable even during crises are usually good bets. The low level of debt, as businesses with high debt may struggle in turbulent times. The high cash generation, since companies that generate money even in difficult moments tend to survive and thrive afterward. If the brand is strong and has a competitive advantage, because if a business has something unique and hard to replicate, it has a better chance of recovering quickly. An example of this was Amazon during the crisis of 2008. Its stock price dropped drastically, but its business structure remained solid. Those who bought at that time saw astronomical growth in the following decade. If you want to benefit from crises, you need to change your mindset. Don't see the market as a casino, but as a discount fair where you can buy valuable assets at low prices. Warren loves to quote a phrase from his mentor, Benjamin Graham. The market is like a temperamental gentleman called Mr. Market. Sometimes he is euphoric and sells everything at high prices. Other times he is depressed and sells everything cheap. Your job is to take advantage when he is depressed. This means that instead of being scared when the stock market drops, you should see it as a clearance sale of valuable assets. A classic example of this happened in 2020 with the coronavirus pandemic. The market panicked and stocks of excellent companies plummeted. Buffett, as always, remained calm. Those who followed this philosophy and bought good companies at that moment multiplied their money within a few years. Here's the secret. If you learn to stay calm while everyone else is panicking, you will be among the minority who get rich in times of crisis. If there's one thing Buffett teaches us about crises, it's that they are not moments of despair, but of opportunity and growth. He built his fortune by buying valuable assets when the market was gripped by fear. Now, you might be wondering how to apply this in practice. Start by creating a financial reserve for investments. Don't invest all your money at once. Have funds available to take advantage of future opportunities. Identify good companies and study their fundamentals. Don't buy stocks just because they have dropped. Buy them because they are solid businesses. The next time the market goes into crisis, take a deep breath and remember that it is in these moments that the greatest fortunes are built. If you apply these principles, you can turn any crisis into a springboard for financial success. And if you enjoyed these lessons and want to learn more about achieving financial independence inspired by the great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video.